Hello everyone and welcome to another market update. Today is Wednesday the 9th of April. It's been probably about 10 days since I did a market update, and in that time we have had the wheels literally come flying off markets. So today's top three things are going to be tariff tantrum, the volatility of it all, number two, and rates, number three. My, how a difference a couple of months can make in terms of market time and cycle time. So before I go deep into any analysis, let's just consider where we are at the moment and where we started the year. So we started the year, things were looking pretty good. We had the election, post-election tailwinds. Trump came in, started doing a whole bunch of stuff. We had crypto popping. We had the markets pretty buoyant on all of that news, and we're making new all-time highs in most parts of the market, particularly in the Mag 7 as well as in sort of the broader market. Then all of this tariff stuff started to come into the conversation around markets, around geopolitics, and it started off sort of being a little bit benign in terms of people going, okay, well, Trump put saying he's going to do tariffs, then he would roll back on that, then we're back on again, and we went through a little bit of a period of time that was volatile, but it wasn't the volatility that we have now, which I'm going to talk about in a moment. And then the wheels just came off. It was very clear that Trump was going to be very explicit about the tariffs, and they were going to be enforced, and that is exactly what's happening right now. And frankly, the world doesn't like it. It is something that I'm still trying to fully understand how all of this is going to play out in the geopolitics of it all. My sort of high-level impression of this is that the United States for a very long time has taken on all of the consumer purchasing of stuff that gets produced by other parts of the world, namely China, India, a lot of Asian countries, and Europe, without really protecting their own industry. So a lot of U.S. industry went overseas to lower cost areas and so forth. And so this tariff issue is the U.S. now taking on a bit of protectionism and trying to claw back some manufacturing jobs and claw back some purchasing power and things like that for U.S. citizens and people that reside in the U.S. and earn money in U.S. dollars. And of course, the parts of the world that don't like it, of course, are going to be China and places like India and Vietnam and the Philippines and Bangladesh and Sri Lanka and all these places where labor is really cheap, and there's a lot of goods that get produced in those countries and exported to the U.S. That's a very high-level sort of layman's view of it. There's some stuff that I'm going to try to consume that Hedgeye's produced on this through with some tariff experts. I'm going to see if I can't get a little bit more of a handle on that. In spite of all of that, the markets don't like it, and we've had a huge correction bordering on now a crash in markets, specifically in tech, in consumer discretionary, in pretty much any part of the market, the S&P 500. And so this is a massive tantrum that's going on. There's a lot of high-level or surface-level attacks going on, against Donald Trump. And I'm sitting here just saying to myself, let's just see how this plays out, and if this is really going to be beneficial for U.S. citizens in particular, and how the world responds to this. Because I think ultimately a lot of these tariffs are between the U.S. and another country. It's not happening across the board. It's not a complete everyone is tariffing everyone kind of situation, which may provide some loopholes, if you will, where, for example, if China exports to Australia and stuff happens in Australia to those goods, and then Australia ships it to the U.S. and they avoid having a big tariff put on it, stuff like that is going to almost invariably happen. That's going to take some time to sort out, and we'll just have to continue to watch this movie and this slow-moving train wreck and see what happens. There's also the possibility that this is just a huge, massive bargaining tool, and in the next couple weeks we will see deals being made between countries to increase tariffs, but not to the level that Trump has imposed. I don't know. We'll just have to see. So I'm trying not to react too much in terms of the geopolitics of it. Obviously, my job is to analyze and look at markets and to do what they're doing and to protect your capital as much as possible. So to that end, and I'll talk about that as well, to that end, I want to just touch on volatility for a moment. I've talked about volatility for years, and specifically, there's really three volatility measures that I look at. The VIX, which is the S&P volatility, which really is the broad market volatility. So when you talk about VIX, that's a good measure of the broad market itself, because there's 500 companies in the S&P 500, and it's a cross-section of industry, so it's not just one type of industry like tech. It's industrials, it's communications, it's consumer, it's a lot of things in that index. So you could say that's the broad market volatility. You have then the tech volatility, or the NASDAQ vol, which is VXN if you're looking for a ticker to have a look at. And then you have the Russell, which is the small cap index, which is RVX. And just to refresh on the volatility levels, the investable bucket is between sort of 9 and 15 or so VIX. If we're in that volatility regime, really anything, I suppose, less than 19. If we're in that regime, that is investable. You can be in stocks, you can be in just about any equity, and feel like risk is not ever present in the market, in the sense that there's some big event that could happen that's going to erode your capital. Once we go between 19 and about 27, 28, 29, that's what's referred to as the chop bucket. So that's a higher regime of volatility, and it means that stocks are bouncing around a lot more. The moves get more pronounced. We might have big up days, big down days, and you just get a lot of swings in the market. People and traders get whipped around, as they say. Then you have the F bucket, which is exactly what you think that word means, and it is pretty much 30 VIX and above. The VIX closed yesterday in the U.S. and on the S&P 500 at 52. So we are well and truly in the F bucket, and these are levels that we haven't seen since really the COVID crisis kicked off. So volatility now is in the volatility regime where you simply, as they said, in the Jaws movies, you cannot go in the water. It is not safe to go back in the water. And volatility spiked very quickly too, by the way. It was sort of hovering in the around 20 right towards the end of March, and then it spiked actually, it made an intraday high of 60 on the 7th of April, a couple of days ago, and then on the 8th of April, this is the closing from yesterday, 8th in the U.S., closed at 52.33, having had a pretty large range. So what that means for us as investors is we have to have less exposure to equities. Now the good news is I really took off a lot of equity exposure in the lead up to all of this, because there were market signals that were suggesting that things were not well. We had a quad 4, monthly quad 4 for the month of March, and now it's very likely that April will end up being a quad 4, but we're still early days in April. It could end up being a quad 1, but I think we're going to have to see some sort of relief in this whole tariff issue before we can say that for sure. But nevertheless, I was able to sell down and get out of a lot of equity exposure. I didn't get out of all of it. There's still equity exposures on in your accounts in Interactive Brokers, and then for those of you on Hub 24 as well. And for a lot of new clients who were just bringing on board and getting onto platforms, you're predominantly sitting in 100% cash. So because of the nature of how I manage money for my clients, we have existing clients that have portfolios on, we have clients that are bringing money on, and we have brand new clients. And so there's varying degrees of what your account may or may not look like. The good news, though, is that for those of you who have been with me for a long time, just to recap sort of the 2024 time frame, and you can go and have a look in your any of your accounts and you'll see something similar to what I'm about to say. We had a great year last year, 20% plus returns for most clients, some edging up into the 25 to 30% range, which is fantastic. This year, year to date, we are sitting at somewhere between a 5 to 7% loss, unrealized, of course, showing in accounts at the moment, and which is better than what the market's currently doing, which is well, I mean, here's a couple of charts for your for you to, I suppose, consume. Retail investors are absolutely getting hosed. These are people that are bag holding, the Mag 7, crypto, all this stuff. They are just getting pummeled by this market crash. And year to date, just broad market indices year to date, sector performances. This is a very telling chart where we have a lot of this everything is red, like it's just a sea of red at the moment, both quarter and year to date. And as you can see, a lot of the market segments that the retail investor would be holding, I'll just highlight a couple here. Tech down 20%, S&P broadly down about 14%. These are epic sort of drawdowns and ones that you would certainly want to have avoided. But I guess the point here is to say that if you juxtapose, say, this tech sector loss of 20%, if you're only down about 6, well, great. That's you're winning. You've generated alpha. Yes, it's still a negative number, but you generated alpha. The other thing I want to say about this is, of course, most of you who are in self-managed super funds, and then some of you who have just individual accounts or trusts, family trusts, and so forth with me, will have money in the Keystone cash flow investments, which are real estate-backed Aussie property investments underpinned by Palace Capital. Now, these have zero volatility, which is fantastic, because when the market's got 50 vol and you have a zero vol asset that you're holding, you're doing very well. Plus, in most cases, there is either a fixed return that you're receiving, or it is a floating return, but we haven't seen any rate cuts yet, which I'm going to talk about in just a moment. And so that side of your portfolio is going to generate return for you this year and smooth out all of this kind of small negative stuff. So I guess really what I'm ultimately saying here is we're weathering this storm very well. The other thing I want to say about this is the current portfolio construction, and you can go in and have a look at your portfolios and see this. I've repositioned into holding a lot of cash via short-term treasuries. So there's a ticker called T-bill, TBIL, which is a 3-month or less short-term treasury ETF in the U.S. that pretty much has zero volatility and just pays a coupon or an interest rate of about 4%. This is in the U.S. per annum. So that'll just tick over until I sell that down to reallocate into things like tech and so forth. Gold is another big holding that I've put on recently. I'm also taking some exposure to investment grade corporate credit, so AAA rated bonds and corporate bonds, and then also long-term treasuries. Now the long-term treasury one's a bit funny at the moment, where interest rates, and that was my third point for today, interest rates are going to be cut. All of this stuff that's going on is going to force the Fed to cut interest rates, and I don't know, I dare say, if I was going to guess, be a betting man, I suppose, I would bet on probably a 50 basis point rate cut by the U.S. Fed when they next meet. It'll be interesting to see what the RBA does as well, because I think Australia's got a different problem than the U.S. Australia's issue, and I've talked about this a lot as well, is really the resurgence of inflation. And with tariffs and stuff, what we could see is that could be inflationary for starters, although the price of oil has come down a lot, so that's going to give us a huge relief in the inflation calculations. But real estate, rentals, healthcare, a lot of stuff, food is still expensive and prices continue to rise there. But the fuel could be enough of an offset. But the other thing is our currency keeps dropping. So the Aussie dollar, when all this stuff started to happen, dropped by a couple of cents. And just to give you an idea on that, March 31st it closed at 62.47, 62 cents, 62.47 cents on to the U.S. dollar. It is today trading at around 59.75. So it's dropped pretty remarkably over the course of a 3 or 4 day time frame. that could be inflationary. So I don't know that it's an absolute lock that the RBA in Australia is going to cut interest rates. I suspect they will anyway because of all this stuff going on. I think they'll try to give some confidence, that they'll use that as a confidence booster. Whether or not, as I'm reading some articles at the moment, they're already banging the drum now, like, oh, they got to cut 50 basis points, blah, blah. Whether they do 50, I don't know. We'll see. I mean, all we can do is see. You just don't know about these things. But I will say that the inflation boogeyman is not completely dead, and that could reignite inflation here in Australia, because think of it this way. If we get a 50 basis point rate cut and the stock market has basically crashed, what do you think people are going to go do and say? The P word, right? Everyone's going to run to property. Oh, property, property, property. And so, of course, all that's going to do potentially is put pressure, more pressure, on the property market. So rents won't improve, and certainly we won't see necessarily prices of real estate improving either. Okay, that was a lot to sort of cover off. And I think the main thing to take away from this market update, and I have had some of you reaching out asking about, accounts and how they're performing and so forth and so on, is to understand that I have risk managed this reasonably well. Gotten out of a lot of equity exposure, although admittedly there is still some equity exposure in there, but I'm not buying any equities at all at the moment, unless it's related to an ETF that's related to, for example, a bond holding or something that has very low volatility and pays an interest coupon and will protect your capital. Oh, that was the other thing I quickly wanted to say, sorry about interest rates, is that as soon as the Fed starts cutting, the long end of the curve, well, the whole curve will start to fall. This is the interest rate curve, and the long end of the curve will start to come down as well. So that position, like that TLT position that I mentioned a moment ago, which is 25-year plus treasuries, that will start to provide more alpha to the portfolio. So the portfolio is set up right now to weather a quad 4 reasonably well, with positions, and gold as well will do pretty well. Positions that'll do well in that case. And then it'll just be a case of when do I pivot out of that more defensive stuff and back into the tech and the the Mag 7 and the crypto and so forth. I think it'll be probably by the time we get 2 rate cuts from the Fed, so I'm anticipating July or possibly August, somewhere in there, will be the time to maybe reallocate some capital back to those things. And then once we get closer to the end of this year and even into 2026, there's going to be some tax cuts and some other big fiscal stimulus type policies that are really going to put a tailwind in the equity market. So what do we have to do between now and then? Well, basically preserve capital as much as possible. And again, that's why I brought up the Palace Capital Holdings. So for those of you who have Palace Capital Holdings, those are going to provide a nice sort of base level of return that should smooth out. Even if this year we're up 1 or 2%, if the whole year ends up being a wash and the markets stay down somewhere between 15 and 20%, that in my mind will be an absolute win. So I think that was really all I wanted to cover off and really discuss today. But I am absolutely paying attention to this situation. And the good thing is that with volatility in the 50s, I mean, it's really kind of an easy situation to deal with. Don't buy any equities, period, the end. It would have been nice to have sold all equities and been in cash prior to this big move, but we just have to learn, or I will have to learn from that situation and act a little bit quicker next time. But the long and short of it is, you as my clients will certainly not be getting hammered as hard as most retail investors out there at the moment. So that's the good takeaway as well. That's really it. If you do have questions or you want to review your portfolio, you can book yourself into my calendar to do that. I'd be happy to have a chat with you. Just make sure, by the way, when you're booking in a meeting with me, there's a section where you can put in what you want to discuss. Please be as specific as you can. So tell me, I want to review my superannuation portfolio. I want to see where things are at this year, and also it might be worth mentioning any updates. So if you're booking in a meeting specifically to update me on something, tell me what that is. We've had a new baby, or we've had whatever the case may be. That's an example. Most of my clients, I think, are are actually out of the baby having babies stage, but certainly there's a few of you that are still in that, and we're bringing on new clients too, definitely younger clients at the moment too, which is fantastic, looking to grow that book. Yes, so just to lock that off, please do just give me some detail on what you want to discuss, and we can have a catch-up. I'm going to also, by the way, on that Calendly stuff, I'm going to create a landing page on my website that I think this is how it'll work, from my email footer, you'll be able to click on the book a meeting link. It'll take you to that landing page, and then you can select the type of appointment that you want. So right now I kind of only have one appointment, which has a one length of time. So I've created a few additional appointment times so that if you only need to have a quick chat, there's a 15-minute time slot. If you need to have a longer chat, there's like a 45-minute time slot. There's that kind of stuff going on. So that'll give you a bit more flexibility too on how much time you think we need to allocate for a chat. So with that, I will say probably at the end of this week, early next week, I'll do another market update, because this situation certainly seems to be relatively fluid and changing all the time. But the key takeaway is, don't lose any sleep. I mean, please do not be nervous about this market. I have protected you as much as I can. Investments have been made in things that will, barring any huge calamity, and I think it'd be some sort of war that would break out that would possibly cause the whole market to go down. There are certain things in Quad 4 that do well. Gold and your fixed income stuff are the two notables there, and the US dollar, which many of you own, all of those things. So yeah, with that, I will say have a fantastic rest of the week. Next week, I think, is Easter week, isn't it? So I will do a market update prior to that, and just try to wrap us up before we go on holidays. Have a fantastic rest of the week. Talk to you soon. Bye-bye.